Good morning, everyone, and welcome to this ISTAT Learning Lab. Today's topic is aviation credit markets. My name is Sarah Aoun, and I am head of capital markets for Airbus. I am joined today by two of my industry colleagues and experts on capital markets, Betsy Snyder and Mark Streeter. Betsy is a long-time airline and aircraft leasing analyst. She was a credit analyst at S&P Global for 34 years until March of 2024. Prior to that, a sell-side equity analyst. More importantly, Betsy has been a trustee of the ISTAT Foundation and is currently a member of the ISTAT International Appraisers Program Board of Governors. Mark Streeter is a managing director and a senior publishing analyst at JP Morgan. He's responsible for investment grade and high yield credit coverage of the transportation and REIT sectors. Mark specialized in the public aircraft debt markets and shares equity coverage of the public aircraft lessor with his Hall of Fame research partner, Jamie Baker. Before I hand over the floor to Mark Streeter and Betsy, I would like to remind everyone that there's a Q&A box at the bottom of your screen. I encourage everyone to post their questions, which I will be moderating at the end of this session. So please ask your questions, and they will be, hopefully we will get through them towards the end. Betsy, Mark, over to you.
You said we're your colleagues, but we're also your friends, right? I want to make sure we're still friends.
We are.
Okay, that's good. Good morning or good afternoon, everyone. Thanks very much for joining. I think we had upwards of 600 people signed up for this, and I know we have 200 here to start or change, rounding up here. But very pleased to have everyone with us today. And when ISTAT approached me about putting this session together, you know, Betsy was the perfect complement, of course, with her retirement from S&P, and has unbelievable insights. I will say up front, Betsy's opinions do not reflect Standard & Poor's. She's no longer an employee. They reflect her own individual views, because we're going to get into the nitty gritty with the rating agencies and trends in the capital markets and so forth. What we thought we'd do is sort of break it up into two sections, start with airlines first, and then talk about aircraft lessors second. Our airline comments will be a little bit more US focused, but we're happy to apply what we're going to talk about, obviously, to some of the global airlines and some of the trends we're seeing then as well. Obviously, with the lessors, that's much more of a global business. And we're going to be focused more on the US capital markets, because that's still obviously the biggest capital market out there. But of course, we can talk about some of the other markets as well. So just to start, and I'm going to run through a list of topics, throw them out to Betsy. She's going to chime in, I'm going to chime in, and we're going to roll through this. And then Sarah will take your questions as well. So Betsy, just in terms of airlines and the COVID recovery and the balance sheet repair process and so forth, you know, where do we think we stand with that? You know, from your observation, having covered the airlines for a very long time, have you been impressed with the speed of balance sheet repair? How much more work is there to go?
Okay, before I answer that, I want to thank you for your comments on starting out that I am retired from S&P, but not retired, as you can see, because I'm participating in this. And I am a free agent, so I can talk about a lot of things without having to worry about what I say. So anyway, but thank you for bringing that up in the beginning. So yeah, I think, you know, when you think about what happened during COVID, and there was a liquidity crisis for the airline sector, and they had to raise capital, and most of it was debt capital. I think the progress that they've made so far has been pretty encouraging. And I think when you look at what the capital markets as well as the rating agencies have taken that into account by upgrading ratings on a lot of these companies, especially the big three network airlines, not so much on some of the smaller airlines, which we'll get into in a bit. But anyway, so I think that they have done a good job. You know, you look at American, and they're pretty well along in their deleveraging target. Delta has done a great job. Obviously United, they have a big capital spending program out there. So, you know, it's going to take them longer to get to that point. And what about comments on your side?
Well, I'm just sort of wondering from your perspective, Betsy, because one thing that Jamie and I have been focused a lot about, right, is the importance of loyalty, international premium, and sort of the haves or the have-nots, both domestically, but I think you could apply some of this domestic U.S. To the rest of the world too. It wasn't that long ago when Spirit Airlines had one of the best margins in the industry, in the world. And you look at them now and so forth. And so have you been surprised at the importance of international loyalty premium and how the market, at least in the US and in certain other markets, has sort of bifurcated, if you will, and become the have and have nots in that regard?
Actually, I have been. I think it's kind of a new phenomenon that we're seeing here. And I was attending a conference last week, and there was a statistic that was thrown out, and I don't remember exactly what it was, but in terms of loyalty, the statistic was that Gen Z actually has the lowest level of loyalty in the sector. Baby boomers are, wedded to their loyalty programs, but Gen Z will actually go where they have no loyalty to loyalty. They will go wherever the prices are the cheapest to fly. And I'm just wondering if over time that's going to have an impact. The other thing that's kind of interesting is that alliances have become much more prevalent than I would have expected. At this conference, there was a big discussion on alliances, and even some of the smaller airlines are saying that they are interested in having some type of partner in the future. So I think that that's a trend that's going to grow. Obviously, you have the big three alliances out there, and those cover up, in a lot of, they're global alliances. But even some of the smaller airlines are looking to get into this. Regarding the divergence between the low-cost airlines, or as you call them, LMAs, you and Jamie.
Margin airlines versus the higher margin airlines. Although the margins aren't that high, but there is a definite difference between the bottom of the barrel and those that are generating more consistent profits. But yeah, Jamie came up with low margin airlines, I must say. But go ahead.
But I have been surprised at how that has happened and how quickly. And I think a lot of it is driven by the route structure where people can fly, as well as the higher labor costs, because labor costs are up in general across the board, not just for the big network airlines that are all unionized. But I would also put in that category, I've also been surprised about Southwest, because Southwest has always thrived pre-COVID in periods where there's been turmoil in the sector. And they've been a laggard this time around. And, if you go back, I've been following this sector a long time, as you know. Southwest, as I said, they've always thrived. And here their performance has been disappointing in terms of their margins or their operating performance. And yeah, they've been hit by higher labor costs too, I'm not sure what's driving that. Do you have any comments on that, Mark?
Well, I would just say with Southwest, we just had a session with your old colleagues at S&P last week where we were talking about this, right? I mean, they have negative net debt, so the balance sheet's great, right? Think about the unencumbered 737s that they have between NGs and Maxes and so forth, right? It's 10, 12 billion north of that probably, right? So, and with negative net debt, no one's worried about Southwest from that perspective, but the margin performance is just pathetic relative to the hand that they've been dealt, right? And they need to, and I think they're finally getting to a point where their systems, infrastructure, and so forth will allow them to revisit certain things, like having some degree of assigned seating or something like that, being able to sell, besides Business Select, being able to sell a more premium cabin, because they even admitted as such, Bob, on the last call, right, that consumer preferences are changing. But I want to go back to what you said about Gen Z and consumer preferences, because what is fascinating for us right now is to look at the importance of loyalty at American, Delta, United. I'd love to talk about at Delta, where their American Express remuneration is up to, what is it, $6 billion this year, $7 billion, but it's heading to $10 billion within the next just couple of years, right? And then you look at someone like Spirit, which has loyalty-backed bonds, where the actual loyalty cash flow is well less than $100 million. Like, how can Spirit compete with that when their pilot costs have skyrocketed, right? Everyone's paying around the same for cost of distribution right now and so forth. But labor costs in general that have risen, fuel, et cetera, right? And the irony of it all was that in the US, at least, there was a Department of Transportation session with Congress within the last week or so to talk about loyalty. It was driven by someone that wants to change some of the rules with exchange fees for credit cards and so forth, which, as someone who works for one of the largest, if not the largest, credit card companies in the world, I'm sure JP Morgan is very against changing these exchange fees and so forth. But under the guise of all that was this discussion of loyalty, and Spirit basically got in front of Congress and basically said, it's hard for us to compete with Delta and others because of these loyalty programs. And of course, it was the judge in Boston, in agreeing with the Department of Justice, which signed off on the case by closing with, "This one is for you, Spirit customers. We're blocking the deal that's going to make Spirit and JetBlue bigger." And yet, at the same time, look at what both Spirit and JetBlue are doing as the fallout from that deal being blocked. They're both cutting capacity, right, and giving consumers less choice, because there won't be as many Spirit and JetBlue planes flying independently. So it's sort of the reverse of what the government wants. Yet at the same time, Michael O'Leary, right, in Europe is basically saying, to your Gen Z point, loyalty doesn't matter for me. All that matters is that I provide the lowest cost, and my customers and the European customer, there is a strata of those customers where that's all they care about. And obviously that business model is incredibly successful. It's a little bit handcuffed right now because they can't get the Boeing planes that they want. But you look at the success of Ryanair, the consistency of margins and so forth, and how well it's worked over there. Yet the low-cost model in the US right now is basically, if it's not failing, it's been incredibly impeded, to the point where, and we spent a lot of time on this, and maybe we'll get into this a little bit later as well, someone like Frontier, the only reason why they're making money right now is because they're booking $12 million per plane sale leaseback gains and taking it as a reduction to operating costs right now. And that's the vast majority of their positive margin, is all related to sale leasebacks. Frontier really right now isn't running a profitable airline. They're running a profitable aircraft trading business disguised as an airline. But
I would just say this is not new. Southwest has been doing this for years, because and you and Jamie know that, because they pretty much, because of their cash position, they pretty much buy a lot of airplanes, and then what they do is they do sale leasebacks on them. And they actually have made money because they get such a good price when they buy airplanes. And so they've been doing this for years. So
Southwest less so. Frontier, yes, has been doing it for years and has, all the Indigo airlines, et cetera. But Wizz and Volaris are only booking 2 or 3 million in profits per plane. Frontier's booking 12 million in profit. So Frontier's at the extreme end of it. And it's something we've been very focused on. So it's going to get a lot more scrutiny going forward. We've had a lot of feedback on us writing about that. But it just highlights, I want to tie that all into, right, the business models right now between at least the US legacy big three, excluding Southwest, and what's going on at the bottom end of the scale and so forth. Now, I think JetBlue is fixable. Spirit, I'm less convinced on, but we'll see. And then there's a lot of people in between and so forth. But let's continue down, because we're going to get more into that. I want to run through some of these topics before we get down too many rabbit holes here. But Betsy, what's your opinion on the growth of using loyalty as collateral, using slots, gates, and routes, SGR? I like to say route, slots, and gates. Everyone knows that. I got tongue-tied even thinking about it the opposite way. But obviously there's been esoteric collateral. We always had spare parts before and so forth. But when you think about loyalty and all the route, slots, and gates backed bonds, from a credit analysis perspective, what are your takeaways with the growth of that from a funding perspective?
Well, when I was at S&P, we did not rate any of these bonds. So fortunately,
but you rated the route, slots, and gates, right?
yes, we did. And and that collateral, we did, excuse me, we did, excuse me, we did stress it because it's more, it's not like an airplane where you can go out and touch the metal. These are, not as easy to appraise. And so we did stress it, but we did typically look at them as secure debt transactions, and if we did notch them up from the off the issuer rating. So we did give them credit for that. But in terms of the loyalty, and I think you touched on this, if you're one of the big three network airlines, or somebody like an Air Canada or somebody, then I think investors are going to look at the loyalty programs differently than they would if you're JetBlue or Hawaiian. And I think, fortunately we didn't have to make that decision because we didn't rate these at S&P. So, but I think, yeah, there is a big difference in loyalty programs between the big network airlines and certainly the ones who have big credit card partners as well. Like you mentioned, Delta and American Express, and how much Delta has benefited from having them as a partner. So I think that's a big difference between them. And I don't know if there's going to be a lot more loyalty financing other than what's out there, especially in the US. There might be some internationally, but in the US, I think that, what's happened with Spirit and Hawaiian maybe has, cooled off some of the investment thesis.
Well, it's interesting, right? Because if you look at Hawaiian, and they will admit this, right? They have a $1.2 billion loyalty deal in their capital stack on their balance sheet, right? It's too big. It should have never been done at that size. But Hawaiian actually has real loyalty cash flow, as opposed to Spirit, which basically has this Fair Club stuff. And some very creative bankers out there, like in raising money for Spirit and Hawaiian, right? They put in place this loyalty brand structure where this brand intercompany payment, I mean, think about Spirit, right? They have $1 billion of loyalty bonds outstanding, right? Their real loyalty cash flow is well less than $100 million, right? It's really less than $50 million when you strip it out, right? And so how do you support $1 billion of debt, even at 8% with 80 million of interest that you have to cover, call it commercially, 1.5 or 2 times, right? So you need, 150 million plus, call it, of cash flow, 120, 150 million of cash flow from loyalty. You don't have it, right? So the bankers went into their magic box and little hocus pocus, went into the cauldron of the capital markets and sort of whipped up let's put in place this brand payment, right, between the brand co and the operating airline and so forth, and we'll make up cash flow in order to service this debt. That's what was done at Spirit. That's what was done at Hawaiian. That's been what they've been trying to do at sort of some other deals. And, we may not get a Spirit bankruptcy to actually test this, because it looks like Spirit is making progress with renegotiating or doing a distressed debt exchange outside of bankruptcy for their loyalty bonds, and then maybe address the converts. And they're scheduled to have an investor day beginning of August. The irony is that Spirit might have an investor day before United, because United keeps having to push theirs back because of the FAA scrutiny and the Boeing delays and everything else. But, so we'll see if we may not be able to test this loyalty structure that has become so important through a bankruptcy process, but it would be fascinating to do so. Okay, because I think these brand interco payments, especially where the brand is, let's take a step back here, okay? The Delta, American, United brands are brands that have staying power and perpetuity, right? JetBlue was going to buy Spirit, and that brand was going to go faster than anything, right? Thrown out the window, right? They were going to rebrand the aircraft JetBlue and so forth. The Spirit brand was going to be dead. It's the laughing stock of Saturday Night Live and late night television, the brand itself, the brand connotation, right? So basically, how do you, in a bankruptcy scenario, right, what is that really worth and so forth, if the name's being changed, et cetera, all of this could be challenged, but may not be, because and by the way, the domestic environment is getting better for Spirit and for JetBlue, we think, right, just because of their self-imposed discipline, right, and the economy is still doing pretty well and so forth. They're not going to be thriving, that's for sure, but will they be generating as negative cash flow as they were in the fourth quarter of last year? You know, we do think the outlook is a little bit better for this year, and they have a shot of, restructuring outside of bankruptcy. But the other thing I want to bring up on loyalty, Betsy, which we talked about with your colleagues, and I've talked about your old colleagues, and I've talked about with other rating agency folks, is the equitization of loyalty. And I mentioned that United Investor Day, and we know for a fact that one of the key parts of that United Investor Day was going to be a much deeper dive into loyalty economics, because the frustration is very high at American, at Delta, at United, where the stocks are only trading at, call it 5 times earnings, when the market's trading 3.5 times multiples of that in absolute terms. The market's at 15 to 20%, right? Airlines are trading at 5 times, right? So the broader market, right, trades at just a much, much higher multiple, right? And so there is a lot of work being done to sort of figure out that these loyalty cash flows, which are so stable for the big guys and so big for the big airlines, how do you tap into that? How do you monetize that? You know, it's one of the reasons why we keep telling investors to own the big 3 loyalty debt, because if they want to do any of this, they're probably going to have to pay consent fees or take it out or whatever. But there are lots of creative people, including here at JP Morgan and on the street, that are looking at ways to tap into loyalty economics, do some sort of back-end private equity participation or something like that. There's been some very unique structures done, sort of preferred securities out of Europe based on loyalty. So I want to throw that out there. My question for you, Betsy, right, is that, because I know you haven't worked on rating the loyalty deals, but when you think about, if you're analyzing an airline credit and they have pledged loyalty for debt, or they somehow sell a participation in that loyalty cash flow, how do you think that impacts the credit quality of the airline?
Well, I think we would have to look at each independently and say, what, and do a recovery analysis based upon what's going where, who has access to the cash flows, and then that's how we would determine. And it could impact the actual issuer rating, but it might just impact some of the debt that's outstanding. I know that when these loyalty programs first came into being in the summer of 2020, we did go back on our recovery analysis and look at where these, even though we didn't rate them, look at where these fit in the capital structure. And it did have an impact on some of the unsecured debt rating that was outstanding, and the recovery potential.
Excellent. We have a lot more to get to, so let's keep rolling here. So EETC market, obviously with all the Boeing delays and even Airbus's own supply chain difficulties and so forth, have you been surprised just how quiet the EETC market has been? Is it tied to just the lack of airplanes deliveries, in your opinion? Is it tied to maybe people moving away from the EETC market because the leasing channel has been so aggressive, or because of the cash balances? Why has the EETC market been pretty dead?
I think it's because of the lack of need for capital. As you said, all these aircraft delays, capital spending is down, and they can, what they have coming in, they can, and they also have debt that's being amortized over time, so that there's less debt in the capital structure as we started out our discussion. So I just think there's less need for debt financing, and that is one of the areas where there's no need for it. And when you think about it, it's a relatively small market. I mean, how much is outstanding in this market that investors pay so much attention to? So it's I would think if they're going to do some other types of financing, it might be easier for them to do.
Well, you've heard me say this on conference panels for decades now, right? The size of the WTC market is basically less than $30 billion, right? You have approaching 5 times the amount of US dollar debt outstanding for the lessors than you do in the entire US dollar WTC market. So we don't need to spend a lot of time on that. I just want to give people some spread and yield color right now. If you look at sort of first lien WTCs, really sort of the best names like a Delta right now, they could probably do a deal, very close to 100 basis points. I mean, if they did a low leverage AA tranche, it might even be inside of 100 basis points, sort of 5.5% right now, something like that. What's interesting, if you look at the most recent sort of Delta deal where you have a AA and an A, so a first lien and a second lien, that spread is about 70 basis points. Remember, at its tights, that was, call it 20 basis points. And so that's going to be interesting to see what the price discovery is here between the first liens, the second liens, and whether or not we ever see sort of third liens again, given what went on with LATAM and Norwegian. And we could take questions on that if people want to get into the nitty gritty of those lawsuits and what's going on there, because there's still a fight between some of the sub-tranche holders in those legacy WTCs at LATAM and Norwegian, where there was sort of a forced fire sale and so forth. And just on the loyalty bonds and the route slots and gates bonds, in terms of spreads on the loyalty bonds, really the on the run tranches are all sort of inside of 150 basis points right now in spread. I mean, this is paper that is yielding around sort of 6.5%. The route slots and gates bonds tend to trade a little bit wider in spread and a little bit wider in yield, but not that wide. So it's interesting to see how that plays out. I mentioned Spirit, those loyalty bonds that convert, that mature in about a year and 4 or 5 months or so, so about 16 months. Those are trading in the sort of mid to high 70s, sort of 77-ish, around 30% yield right now, just to give you a sense for that. The JetBlue converts, which were at one point viewed as very distressed, have rallied a ton. Those have come back to a single-digit yield now and so forth. And I think it can be easily refinanced with their unencumbered collateral, but just wanted to throw that out there as well. So let's do this. Let's move on to the lessors, because we've gone about 25 or 30 minutes talking about the airlines. And Betsy, I know the lessors are, if they're not your first love, they become your first love over the last decade or so, because I don't think anyone at the rating agency spent more time on the lessors than you. Matter of fact, the number one thing I heard from your retirement announcement with the lessors were like, what is S&P going to do? Betsy's leaving, and what is this going to mean for us and so forth? And, because so many of these finance teams had great dialogue with you. Let me just start off with big picture on the lessors. How well do you think at the end of the day, I like to think about the 300-year floods that were thrown at the lessors in the last 15 years. You had the GFC, you had COVID and Russia. And I sort of look at them now, and it's amazing that
and don't forget M&A activity.
Well, and M&A activity, but that was of their own. That wasn't Mother Nature or the economy throwing at them, right? I mean, that was like, when I say the 100-year flood, something, very disruptive by the market. And I look at them now, and almost every one of them is in better shape than where they were. Are you impressed with that?
Yes, very much so. In fact, as you've even called me the queen of aircraft leasing, so I thank you for that. I've been following this sector for almost 40 years. I followed ILFC on the equity side before they were even acquired by AIG. And even then, it was incredible. I found some old research reports. It was the same investment thesis then as it is today. So I want to make some comments, and I know that this is one of your questions about AirCap. And I attended the AirCap Capital Markets Day last week. And I want to say that, so when I was at S&P, we were the first rating agency to raise AirCap to investment grade back after they acquired ILFC, and they assumed all that debt. And then in 2019, we raised them to BBB. We were the first ones, and then, you know, within the last year, everyone else has been raising them to BBB. So we were ahead of them by several years. Now, what I want to say is, so I attended this Capital Markets Day, and you were there too, Mark. And, you know, maybe you want to comment after my comments, but I liked what I saw. And if I was still in the rating business, I would have gone back to my committee to recommend an upgrade as soon as possible. So hopefully, you know, if I was still in this, then maybe they would have been upgraded by this point to BBB+. You know, we talked about what they went through this, you know, all these bad things that happened to them. And then they did that huge acquisition of GCAS, and they kept their rating at BBB. You know, it was a $25 billion acquisition. They went to the capital markets and raised $23 billion of debt to finance it. But, you know, when you look at where they are now, their operating performance has been very positive. I think, you know, they're benefiting from the fact that they have a big engine portfolio, not just aircraft, but engines. And they just placed an order for more engines. And I don't know if we're going to get into this engine situation, but, you know, they're certainly in the right place at the right time. Helicopter business is doing well. I have been, you know, I've been kind of skeptical on that business as well, but, you know, I was happy to hear that they're doing well. And the leverage. So they have set this leverage target for, back when we upgraded them in 2019, they had set a leverage target of 2.7 times, and that's debt to equity. They have been, over the last, you know, maybe 2 years, they've been below that target. They now are at 2.4 times. They've done share repurchases. They just initiated a dividend. And I don't see how they're going to get back to the 2.7 times over the next few years. And I see
6
these
is the new target. They did revise it to 2.6. It was 2.7. They tightened it to 2.6. But you're right. They're at 2.4 and change. And one of the questions I asked them was, given that I think BBB+ ratings are a slam dunk at S&P, Fitch, Moody's equivalent, and that's with leverage tolerance up to 2.6. I asked them, and we wrote about this, would you be willing to contemplate if you had a dialogue with the agencies and said, okay, we want to go to A-, but the quid pro quo from the rating agencies is to take that 2.6 and commit to 2.5 or 2.45 or something, or 2.4, because, you know, they seem very comfortable running at 2.4 and change right now, and they still have plenty of cash flow to buy back stock and pay a dividend, and the machine's working very well. But I give Pete credit. He gave a very honest answer, and he basically said, right now, given where spreads are and so forth, and 5-year AirCap spreads, by the way, on their most recent 5-year bond is 93 basis points. So they're borrowing at 5.44% if you look at today's yields. Pete basically said, I'm paraphrasing, are we really going to save anything going from BBB+ to A-? It was very important for us to go from high yield to BBB-. It was very important to go from BBB- to BBB flat. It's going to be important to go to BBB+ because that's kind of what's baked into spreads, and we'll get a little bit of a squeeze tighter, which is why we still have a buy on AirCap, because we think there's maybe just a little bit of that squeeze tighter to go to high BBB. But getting to low A doesn't really do anything for them right now. But don't forget, spreads in the marketplace right now, our high grade index, okay, which is at 101 basis points. Okay, that's the overall high grade market right now, 101 basis points. And the 5-year market is at 83 basis points, and 5-year single A's is at 74. So again, you think about AerCap at 93, say they go to 89 when they get upgraded to triple B plus. Well, the single A market is at 74. So maybe they'll be 15 basis points away from that single A market index. But are they ever going to really trade on top of it? Because they're an aircraft leasing company and things happen, shit happens in terms of Mother Nature and COVID and everything, right? So will they really ever trade on top of that? That's that opportunity set. So that's the sort of analysis we're involved with them. By the way, the 5-year triple B market is 100 basis points. So AerCap is already trading through the 5-year market. And market spreads have only been tighter less than 5% of the time in sort of the modern bond world over the last sort of 20, 30 years. Okay, so spreads are incredibly tight right now. So it's kind of interesting. I just want to throw that in there, Betsy. I think you had a couple more comments.
I just wanted to say that if you go back and you look at where ILFC was when they were owned by AIG, but before AIG got into trouble, on a standalone basis, they were in the A category. And then, of course, you know, AIG was AAA, so they were rated AA at that point. But on a standalone basis, they were in the A category. But I don't recall what kind of pricing they got at that time. Because
it was all anchored though to old AIG, even though standalone they were. It was very much colored by that because they were the only game in town, right?
Right, right. And remember, they had all that. They used to finance everything through commercial paper too. Remember, that was part of the problem too. But
one of the questions that just came in, Betsy, is that with the move from lessors to financials at S&P, because the financials analysts now are taking the lead on it, do you think that impacts sort of the timing of a reassessment of any of these ratings? Because Moody's always had aircraft leasing out of the financials group with Mark Wasden. S&P, with your departure, has made that move. Does that change this process?
Well, I would just add that the criteria, as far as I know, the criteria is that they use for leasing companies at S&P is still the same, even in financial institutions. So, and that criteria was implemented in 2016. And that criteria, for them to change their criteria, it takes years. So I don't see, I mean, based on criteria, I don't see them moving to FI criteria. And I mean, that's all I can really say about that. But I do want to say, just finish this up on AerCap. Like I said, I thought that they had a great capital markets day. I was very impressed. And when I was at S&P, it was always, the mantra was always get the rating right. And I think the right rating for AerCap is BBB plus. And if I was still a rating analyst, as I said, after that meeting, I would have gone back to committee and recommended a BBB plus.
Let me ask this. So with the top end of we have BOC Aviation and SMBC Aviation. Right. They're really the top end. But if we look at the sort of notched up universe because of parental support, the sort of standalone lessors, AerCap is at the top end at BBB plus, or headed there soon. So one of the questions I spent with your colleagues is, why is someone like Aircastle, where their standalone rating is BB plus, hasn't that market sort of proven its resiliency? Everything going on with Boeing and Airbus right now, aren't midlife aircraft even more in favor? And if AerCap is going to BBB plus, if you look at an Aircastle, how can it be 3 notches lower with the same leverage, right? And by the way, they have great parental support with Mizuho and Marubeni and so forth. I just feel like Aircastle still gets beaten up. It's one of my picks, so I'm talking my book here, right? But I feel like they've been treated unfairly given the way the market has evolved. What would you say about Aircastle standalone?
Well, I would say that Aircastle standalone, even if they went to B minus standalone. And you're right, they are making a lot of moves in the right direction. They're reducing the average age of their fleet. I've been impressed with how much they're able to add to their portfolio through acquiring aircraft. But at S&P, and I don't know how this works at other rating agencies, but the analysts who follow the parent, they're the ones who actually determine the importance to the parent, and that determines how much notching up there is. And I think that the parent and again, this is criteria, that even if we had a standalone rating of triple B minus, because of the parental situation and the criteria, they would likely still be triple B minus. It wouldn't have an impact on them.
Oh, interesting that they wouldn't get I thought it was 1 notches or 3 notches for the uplift.
But sometimes if the parent, there's also the notching between, if the only time it can be rated the same as a parent if it's considered core. And I don't believe that Aircastle is considered core to its parent. And
Right,
I believe the parent might be rated triple B.
Well, the parents are rated, yeah, Mizuho is rated A minus or whatever.
Yeah, but it's not, yeah, it gets very complicated, especially at S&P. I don't know how it works at other rating agencies.
My whole point is, I just don't think there should be a 3-notch difference between AirCap and Aircastle. That seems ridiculously wide. But I want to get into a couple other rating nuances, because how many times, Betsy, would you guess someone has called you to ask you about the GALC bonds that sit at the holdco, the old H&A, Bohai, Global Aircraft Leasing, holdco above Avalon, OpCo debt? How many phone calls have you had in your career with people asking you about those bonds? It's probably over 100, right?
Yeah, I don't remember, but having said that, I had the fortune of being of looking at some of Bohai's other operations, including Seaco, and following the marine cargo container lessors when I was at S&P. And when I saw last year that that Triton was being acquired by a Brookfield Infrastructure, not Brookfield Asset Management, who's taking a stake in Castle Lake. But when I saw that and the premium that they were paying, I said, hey, this Seaco is a valuable asset. And I started telling people that, the potential sale of Seaco could certainly help with pay down those GALC bonds.
Hasn't happened. And those bonds mature in 4 months.
I know.
So we spent a lot of time with your old colleagues talking about this last week. But if you were an investor in Avalon, or a shareholder of Avalon, or an employee of Avalon who's maybe on this call, would you be nervous about what's going on at the holdco, knowing that $2 billion of debt is maturing in 4 months? Now, 70% of Avalon is worth basically $6 billion at book, rounding up. Okay, so you have $6 billion of equity value controlled by Bohai, H&A, GALC, whatever, securing $2 billion of bonds. So you're 3 times coveraged, or you're 35% LTV. So there's plenty of collateral coverage, but there hasn't been enough cash flow to consistently service those debt payments, debt service, because of the very prudent governance at Avalon, the 50% dividend policy, and the fact that if you're only paying 50% of those dividends, and then only 70% of those dividends flow into this box, you haven't been able to service this debt at $2 billion at a very low interest rate. And of course, if you look to refinance it at today's market interest rate, even at a lower amount, you still need a lot of cash flow. We go through all the numbers in a note we put out on Avalon, but I'm just wondering from your perspective, because Avalon is very focused on getting to a mid triple B rating. We think they deserve it, certainly on a standalone basis. And certainly if AirCap is going to be triple B plus, why can't Avalon be mid triple B? But does all of this noise there, does it prohibit that from happening, in your opinion? Fitch seems to say no because they have a positive outlook. Moody's, I haven't asked them recently, but they seem to imply that there was a path there, even if this noise continues at the holdco. And we talked to your S&P colleagues about this last week, and they said they kind of maybe said something a little bit different than what you've said historically, which is they think that there can be a path to an upgrade there, even if we just sort of kick the can down the road here with the holdco. But what are you thinking about this? And how should we be thinking about this from a risk perspective?
So when I was at S&P, the rating on Avalon did not include, it was completely insulated from anything above Avalon. And that's how we got to the investment grade rating that we did, as well as the governance structure with the Oryx 30% stake, which has worked very well. But so, if Galc were to default on these bonds, that shouldn't have an impact on the Avalon rating. Now, when you say that the S&P people are maybe looking at this differently, when I was there, we were looking at the ultimate ownership of Avalon. If Bohai or Bangta were to sell its stake in Avalon, who would be its 70% stake, who would be the potential buyer. So that was really the gating point there with the Avalon being upgraded. It had nothing to do with the Galc debt and a potential default.
Well, could the status quo, and by the way, I don't think these bonds default. I think somehow they get paid down, refinanced, whatever. Very important to say that, right? I don't think anyone's turning the keys over on 70% of Avalon ownership or even going into a restructuring. That would be stupid. Okay, but if it just gets refinanced and kicked the can down the road and Avalon remains 70% owned by Galc, Bohai, H&A Trust, and 30% owned by Oryx, so the status quo remains, can they get to mid triple B?
I guess it depends on how, theoretically they could, based upon what I said, that we're not including these Galc bonds. And it depends on how the analysts there view the ownership structure going forward.
Yeah, I mean, I don't think, listen, this is my personal opinion here. Obviously, all these are my personal opinions, right? I think this ownership structure at Avalon is still in a temporary holding state. I don't think the H&A Trust that controls Galc and Bohai is the right long-term holder for this stake, and I think it needs to move over time. We don't know where it lands, but I think Avalon's platform is destined to be higher rated. It's just a question of how we get there and so forth, and can we get there with the rating agencies without a change of ownership? Sounds like we can, which would be good news, because Avalon, I think, certainly deserves to be mid triple B. But let's talk about, it's been very interesting what's been going on with the three high yield lessors, because we have Castle Lake, which has said they want to be investment grade, but are they really focused on it? They haven't been a big unsecured issuer or whatever. But then you have Macquarie and Griffin. And Griffin, of course, with Ryan McKenna and John Beekman, a lot of people know them through the ISTAT community. They've been laser focused from the start of that company, right? Trying to get to investment grade and so forth, right? And then Macquarie sort of showed up and got rated and did the big Alafco deal and, has found its way to a double B plus positive with S&P. Griffin's still at double B minus with S&P. Fitch, they're mid double B, excuse me. But what do you see as the path for a Macquarie or a Griffin to get to investment grade? Do you think they get there? I certainly do, but I want to hear your opinion. And what are sort of the gating items for them to get there?
Well, I think Macquarie has the easiest path since it's double B plus with a positive outlook. I think one of the things when I was there that we were looking at was the level of secured debt in the capital structure. And with the recent debt issuance that they did of unsecured debt that was used to pay down some secured debt, as well as the acquisition of Alafco, I think, and reducing the average age of their portfolio, because some of those aircraft are pretty old. I don't know if you recall, Mark, when Macquarie was first starting up, GATX used to have an aircraft leasing business, and they sold that business to Macquarie, and that's basically how they started up in the mid-2000s. So I think Macquarie has the easiest path to get there because they're pretty close. I think,
yeah, I mean, they're on the doorstep right now, but Griffin's the more interesting one, right? Because their S&P rating is low, their Fitch rating is a notch higher. They've made great progress. Matter of fact, they kind of prepared for investment grade even a little bit more quickly than Macquarie in terms of the size of their unsecured revolver and so forth, and very limited, obviously, how they're the mix of unsecured and secured debt with their growth and the like, right? But they haven't proven the business model in terms of flipping aircraft. Now, there's been articles out there. Air Finance Journal ran something saying that they're going to float a portfolio and book some gains. But given how important that is to Griffin's strategy, right, to own aircraft and then sell them at a young age and book gains and recycle that capital, how important? I guess it's maybe a self-intuitive question, but obviously we're waiting to see them do that. How important was that in your analysis of the business model?
Well, when I was at S&P, size does matter. And that was a factor in the Griffin rating. And as you recall, when Aircastle went to investment grade, what was it, in 2018? It was also based on size when they
got to what, 7 billion, 8 billion? What was the size that they got to?
Well, it was basically the number of aircraft, not the value of the portfolio. So in Griffin's case, size is a big factor. Track record, you look at Ryan and his track record and at Air Lease, but then and John has done a great job in raising capital for this. But one of the other items there that is at S&P, and again, I don't know how other rating agencies look at this, but ownership. And we view Bain as, or S&P, not me. S&P views Bain as a financial sponsor, and that is, that's an impediment to getting to much higher ratings. I think it could, even if I think it, wait, I was going to say, I think it could go to BB at S&P, but, I don't know how much more headroom there is after that under the current ownership structure.
But even the fact that, unlike, say, an Ares and a VMO or something like that, or a KKR and an Altair, right? I mean, if you look at the Griffin relationship with Bain, right, it's really a partnership, not an ownership, right? They're a capital providing partner as opposed to sort of owning and incubating an aircraft leasing, right? It's a different setup, to be fair. Is there flexibility to take that out from under, a pure private equity ownership and do it separately? Or did you guys just swept it under the rug basically and viewed it all the same, I guess?
That's something that they would have to look at internally at S&P about changing it. I can't speak to that.
So I know we've got a bunch of questions that are queued up. I'm sure Sarah has a few, but I just want to ask, talk about a couple final leasing topics. Number one, consolidation. Do you think we'll see more consolidation, Betsy, in the leasing space? And the numbers sort of show that there's more lessors, not less lessors. So do you anticipate more consolidation?
I think if there's consolidation, it will be some of the smaller portfolios that are out there. I don't know, what's happening with VMO. That's been for sale for a while. So
what's happening is supposedly DAE had it circled, and for whatever reason, Ares and VMO wanted more money, and Feroz kind of indirectly spoke about it on his last conference call. That they're going to be disciplined in terms of their return hurdles, given where interest rates are and so forth. And, they didn't address it directly, but clearly they walked away either over financial terms or whatever. So Ares has pulled VMO back, I guess. We'll see what happens. but that's a platform that they had the Alafco deal in their lap. They decided not to do it. They basically gave it to Macquarie. So, I don't know what their commitment is to the platform.
So I would say that, maybe some smaller portfolios. I don't see any big M&A out there like we had over the last few years with SMBC buying Goshawk and AerCap buying GCAS. I don't see any more big deals. Oh, and then the Standard Chartered transaction. So I don't see anything big out there. But what I want to say is that I find it interesting that we still have new capital coming into this space. And I mentioned the fact that Brookfield Asset Management is taking a 51 stake in Castle Lake. Now that's all of Castle Lake, and aircraft leasing is only a part of their business. But then there's also this new aircraft leasing company that I saw, this engine leasing company, based out of Korea. That it's a startup. It's wait, I
You're
had
talking
this.
about Jeff Lewis's organization.
Yeah, right. And that's a startup in engine leasing. So there's still new capital coming into this space. Unlike airlines is, Hanwha. I Googled them to see what else they do, but it
They're
looks like
very large Japanese.
well, it says they're from South Korea.
I mean, not Japanese. South Korean company. I remember seeing the press release that Jeff sent around on LinkedIn and everything. We're old friends, and
yeah, I think it's probably like a Marubeni or someplace like that, a big.
Yeah, but it's a very legitimate company for those of you that don't know it. And so I think they're very serious about building out this platform. So it's going to be very interesting to see. And it's kind of funny too, because you look at FTAI, Fortress, on the engine leasing business, and I'll just pull this up here because it's been an absolutely amazing run. I think last I checked, the stock was up year to date. Fortress, remember, Fortress split into two companies, Fortress Transportation, the infrastructure they spun off. So now they have a pure engine leasing company. So that engine leasing business, which also does PMA parts and so forth, for those of you who aren't familiar with FTAI, it's up 68% year to date. And we think AerCap and Air Lease stock have done well, which are also doing, year to date, AerCap's up 22% and Air Lease is up 17%. Okay. But FTAI's up 68% in aircraft in engine leasing. So the engine leasing business is hot, obviously, given everything going on with Boeing and to a lesser extent Airbus in terms of supply chain. And you've got Jeff Lewis with this new entity out there. You've got AerCap, right, which just as part of the Investor Day announcement, Capital Markets Day announcement, ordered $3 billion of engines from CFM, GE, SNECMA, whatever we want to call it. And so there's a lot of focus on engines right now. And obviously, there's still, some engine securitization stuff going on in the background, which brings us to last topic, Sarah, which maybe is the first question that I have in terms of some of the ones that showed up online here, which is, what do we think about the ABS market and whether or not E-notes come back? And the one thing I'll just say there is that, the ABS market has been left for dead how many times over the last 20 years? It always seems to come back maybe a little faster and with more gusto than people think, although this time that it's been in sort of hibernation, maybe a little bit longer just because the Boeing and Airbus aircraft aren't there to grease the skids and make the whole ecosystem turn and result in these deals. And these E-notes haven't necessarily, it doesn't seem like the market has figured out a way to sort of restart the E-notes. But I don't like the aircraft ABS market. I think investors have been perpetually burned by it, and I think there's been a lot of bad assumptions, and it's created trading opportunities. But I'm much more of a recourse credit guy and think the market underappreciates recourse and over appreciates cash flow flowing through a lockbox and so forth, because that's how you really get burned. But I'll just say that I think the ABS market will come back. I think there will be e-notes at some point in time with different terms and so forth. But when it comes back and with what strength is going to be a function of the entire ecosystem having more aircraft to trade and Boeing and Airbus delivering more airplanes. But Betsy, any observations? Because that was one of the questions.
I would agree with what you said, and I think it's interesting that over the last few years, the shift, the focus has shifted to loan portfolios rather than operating lease portfolios, because there's been several transactions in that space over the last, or more so than operating lease transactions.
Yeah, I mean, look at what Jennifer has done at Ashland Place, and so forth, and the securitizations there done a great job building out that platform. Sarah, we've gone exactly an hour. I know we have 8 questions online in the Q&A, and you probably have some more. So why don't we shut up?
You've answered a couple of them already, Mark. So thanks for making my job easier. But going back to the consolidation conversation, one of the topics we didn't cover is some of the Chinese lessors. And I don't know if either one of you is tuned in enough on that, but do you have any thoughts on the regionalization? Some of the Chinese lessors seem to be offloading portfolios that are non-Chinese, etc. Any thoughts on that?
They are and they aren't, right? Because if you look at, remember Air Finance Journal ran an article, what was it, 2 years ago or a year and a half, talking about the Chinese lessors are getting out of the Western business. And then I remember meeting with several representatives from Chinese lessors basically saying, it's just not true. I mean, look at what we're doing, right? And so obviously, you can carve out BOC Aviation because they're publicly listed and so forth. And the article was never sort of directed at them.
They're not considered a Chinese lessor.
Well,
They're considered a Western lessor.
Exactly. That's why I said we're carving them out, even though the C stands for China. Okay. But if you look at the rest of the Chinese lessors, they really have been, I think one of them just stepped up for some of the United 321s that they were, United was scrambling to get done, right, in light of the MAX delays. And I think some others have announced some Western deals. So I think both sides might be right? They might be selling some Western portfolios, but they're still doing new Western business. And it doesn't seem like they're immediately going to turn 100% of their focus on their domestic market, that there's still going to be a Western component. That's my observation. Betsy, anything for you?
Well, I think I agree with what you said. I know that they were, after COVID and with the Chinese market being closed, and also access to capital has been constrained as well because of all the problems that the Chinese investors and lenders have had. I think that was part of the problem. But I think, as you said, it's going to be a combination that they'll continue to sell down some of their Western aircraft. But if the opportunities are there, they'll add to it. And if you look at the Western lessors, they've pretty much been reducing their exposure to the Chinese airlines as well. I mean, look at Air Lease. They're down to like single digits now.
And that's one of my biggest, people ask me, what am I most worried about with the lessors? And I'm most worried about, mainland China attacking Taiwan and anything with a Chinese taint to it. And, I worry about people in the market saying, okay, who has China exposure? The Chinese market is such a growth market for aviation. I think, leasing stocks trade off, leasing bonds trade off. People get nervous, if we have escalations rise over Taiwan, but it's not my base case. It's just, we talk about a black swan event, and no one's calling for the next COVID, but that's out there, right? And just the Taiwanese situation could be the next black swan. I hope it isn't. I'm not planning for it, but it's something that when we analyze investment opportunities and credits, we're looking at what is relative China exposure, just to make sure that we're getting appropriately compensated for whatever that risk is.
Well, speaking of black swan, Mark, how would you say the current aircraft lessor exposure to the Middle East compared to the lessor exposure to Russia prior to the invasion of Ukraine, in terms of geopolitical risks. Do you see that as a concern? Any
I don't
thoughts
think
on
many
that?
lessors are doing many deals with Iran or Iraq, right? So I don't think we.
I mean, the Middle East in general.
But I'm saying, right, if you look at where the exposure is, or you look at DAE, obviously, with their ownership by the Investment Corp of Dubai, right? Or we look at Avilease, or everything going on there. We've been talking about for decades whether or not too many aircraft are being ordered and delivered into the Middle East, and whether or not the Middle East can handle that amount of traffic. And obviously geographically very well connected from a connectivity perspective and so forth. And is there a bubble in the Middle East in terms of aircraft and so forth? I mean, maybe, but can the industry handle it? I think the industry can. Again, one thing we didn't really talk about here, and I'll just throw this out here now, is when we talk about global traffic, and I'm preaching to the choir because most people on here are going to be aviation professionals, right? But keep in mind that the global traffic recovery is really more robust than what we're seeing in the numbers, because airlines are stupid, right? Airlines want too many aircraft, right? And they can't get too many aircraft right now because Boeing can't make them, and Airbus also has supply chain problems. So production rates aren't as high as the airlines want, right? So, Adam Pilarski, our near and dear friend that everyone knows very well, was always talking about the aircraft bubble and so forth. And COVID popped the bubble, right? And whatever bubble there was, it popped, but it popped so far below, right, where we really should be long-term in terms of trend, right? So, and this impacts Middle East when we think about traffic flows and so forth, right? Now, remember, all this extra capacity that the airlines want that would take us from below optimal to above optimal, what would that do? That would stimulate fare wars and therefore stimulate more traffic because the price elasticity equation, right? So traffic, right? And then we have pilot constraints on top of that, right? So the actual underlying percolating sort of traffic recovery is really stronger than what we're seeing in the numbers.
Okay. One of the questions here, and I don't see any of our Griffin friends logged on, but it's a question on Griffin. How does a company like Griffin borrow lots of debt at 8%, now just under 7%, buy high quality new aircraft with great airlines, and make positive equity returns?
Yeah, well, if you look at where their borrowing costs are right now, right, the Griffin bonds are sort of inside of 7% right now. So
that's why the new debt was issued at. Initially they were at 8, the first transactions, yeah. And then the more recent ones were what, 6 and change.
Yeah, the lowest coupon they have is 6 7/8, and that deal is actually trading a little bit tighter right now. So, Sarah, listen, it's a great question, right? And a lot of it is going to depend on how well they're buying, right? And remember, opportunistically, they bought some Boeing whitetails during COVID, et cetera. And, guys like Mark Baer have unbelievable relationships, right? And, are they going to be able to find some deals where they can make it work? We think they can, especially if they can, their timing's pretty good, right? Because they've been buying and building during this market where values and lease rates are taking off, pun intended, right? So can they sell into that strength and book gains and so forth? And I think in the near term, the question is absolutely yes. I think the question is long term, can they do it on a recurring basis when the market gets weaker? But I think for now, with the market strength, I think they can prove out their business model, but it's going to remain untested during a true downturn, right? How that plays out. That's my view on it. Betsy?
I would agree. Yeah, in this market, if you can't make money, then you shouldn't be in this business, right?
So just to kind of try and get some of those questions before time is up, can you please discuss the importance of unsecured funding to the lessor business model? How do you think about the value of their unencumbered asset bases?
Okay. Yeah. So, as to be an investment grade rated lessor at, I think, pretty much all the rating agencies, you have to have a certain amount of unsecured debt in your capital structure. And so that's really why a lot of these companies are so focused on issuing unsecured debt, even if it's at a relatively high price. I mean, you look at what happened with Macquarie. They went out to the market, even though the pricing was very high, but they needed to get that level of unsecured debt, increase that level of unsecured debt to improve their ratings. So I think that's really, and it's very efficient. You can do an unsecured issuance. You announce it, you go to the market and you price it that day. So what could be easier? So anyway, I think that's really what the drivers are. Do you have anything? And it's not going away, Mark.
What I will say is that, listen, I've done aviation and real estate for 30 years both, okay? Well, maybe 25 years on aviation and 30 years on real estate, to be honest. And there's a lot of parallels, right? Because you can take commercial real estate portfolios, REITs, basically, you can fund them on an unsecured basis and get credit ratings and so forth. But then you can have CMBS and secured debt as a fallback, et cetera. That's the same thing that's happening in the aircraft leasing model, right? When you get to a big enough size and so forth, right? You want to pursue not only low, but mid or high BBB ratings. You want to fund yourself predominantly with unsecured debt. You want to manage the secured debt down to a very low amount so that you have huge unencumbered asset pools that really serve as your rescue capital in the event what hits the fan. I mean, that was the saving grace of old ILFC. They really didn't have any secured debt, right? So when they needed rescue capital from the government and so forth, you could take the giant unencumbered asset pool, right, securitize it effectively, and take out the unsecured bonds. That's what happens in the real estate world. That's what happens in aircraft leasing. And both industries have been on sort of a parallel path as the number of names involved has continued to expand and these markets become more efficient. And that's what's important about aircraft. The most important thing for aircraft leasing as well is that just look at the amount of debt outstanding. Again, when people call me up all the time, I love telling this story, right? Whenever I get a phone call, hey, I want to talk to you about EETCs. And I say, okay, great. Let's talk about EETCs. By the way, what are you doing with aircraft leasing? And a lot of times the answer from the investor is, well, I don't cover that, or my colleague covers that, or we don't look at that, or whatever. I'm like, well, you better get your act together, because the investable universe and the money-making opportunity in aircraft leasing, right, is 5 times the opportunity in EETCs. That's just facts.
And I would just add, Mark mentioned ILFC, but in the financial crisis, as I said before, ILFC was issuing all this commercial paper because they were issuing it at AAA, AA, whatever. And so they had, because it's short term, they had all this CP coming due. And as Mark said, pretty much all their assets were unencumbered. So it gave them the flexibility to issue secured debt using those assets to pay off the short-term debt. And then as the situation improved, then they were able to refinance that secured debt with unsecured debt. So issuing unsecured debt gives you a lot of financial flexibility if need be.
Yeah. Okay. Just to kind of cover a bit of the sustainability angle, how much discounts are you seeing between green and non-green debt, however we want to define green? I'll let you both define that. Are the capital markets really incentivizing sustainability?
So I will say this, because I coordinate ESG, what we call ESG credit integration for our group globally. And the greenium, or what the market's willing to pay up, right, for anything sustainability linked and so forth, certainly in the US, it's basically nothing. In Europe, you can argue there's a slight benefit and so forth, right? And we have a whole host of ESG related reports from our global team. If people are interested, we just did one on water and biodiversity and governance and so forth. Matter of fact, in the governance report, I was highlighting Avalon and everything we were talking about before as an example of good governance and how it handles that. Because we talk about ESG, we normally just talk about the E part, and we ignore some of the other parts. But really, where we're seeing ESG, or let's be very specific, sustainability linked funding in the global aviation credit markets, it's really been in bank loans. It hasn't been in straight bonds. It hasn't been in really double ETCs or anything like that.
And do you see that changing? Do you see that trend kind of changing over time? And what,
I remember
would
Donald
be
Slattery when he was running Avalon, and Avalon always was at the forefront of the green initiative with the lessors. Donald always said, listen, I'd love to do a green bond. I want you to give me a price break so I can go out and, take my most efficient aircraft and, place them with airlines that care and so forth. But, it's also the skepticism from investors is, well, if you're an aircraft leasing company, shouldn't you be buying the most efficient aircraft to begin with? Like, why do we need to incentivize you to buy the most efficient aircraft, right? And so, I think where you're going to see it impact aviation a lot more is anything relating to sustainable aviation fuel and building that up and so forth. And I won't go on my long tangent on how there's too much reliance on sustainable aviation fuel and not enough focus on the future of engines and airframes and solving the root cause of the problem, which is these metal tubes with two engines don't fly through the sky as efficiently as possible. So we need to improve that. And that's how we're really going to lower the industry's carbon footprint. But for now, we're focused on sustainable aviation fuel and maybe eVTOLs, which keep getting pushed back, if you've noticed, years and years, right? So, but I think, Sarah, what you're going to see is, funding relating to the build out of infrastructure for sustainable aviation fuels and so forth, that being done with some sort of sustainability linked, et cetera. We have seen some of the IAG subsidiaries do some sustainability linked funding in the capital markets. We've also had, just outside of aviation, by the way, some companies do some sustainability linked funding with some key performance indicators that regarding their carbon footprints that they haven't met, right? In part because, and these are more utility companies and so forth, in part because of their transition away from coal or whatever was slowed down by issues sort of outside of their control. And so there's a lot of debate in the market, right, about how willing are people to put forth carbon reduction targets when, for example, if you're an airline and you have a carbon reduction target based on a delivery of Boeing and Airbus airplanes, well, what happens if the airplanes don't deliver?
Yep. Maybe one final question, and that's more of a question to me, but I'll let you guys answer it. Do you expect more lessor orders at the air show this summer? And what is the balance between aircraft cost and future availability via the order book? And for the record, I am not answering this question.
I thought the question you weren't going to answer is how hot is the engine leasing business when we were talking about that earlier. But okay, but back to your question on the more lessors at the air show and so forth. Well, I mean, listen, Jeff Lewis and his engine leasing business, his LinkedIn profile is he's showing up at ISTAT Asia and whatever, the ISHCA has a Dublin conference right now and so forth. So Jeff and his team with his South Korean money is running around the globe, right, trying to do deals. So they're a new lessor, an engine lessor that's showing up, and I'm sure they'll be at the air show, and I'm sure all the usual characters will be there. But Avilease did their debut. What was it? 3 years. I got COVID at the reception.
It was 2 years. It was 2 years ago. It was in 2022 in London.
Exactly. And so, don't worry, Avilease, it wasn't your fault that I got COVID at your reception. But but seriously, I mean, that was a couple of years ago, right? And obviously, we're watching their growth very closely to see what portfolios they're bidding on and so forth, right? And now, we don't know what Brookfield's investment in Castle Lake is going to mean for how aggressive maybe they're going to be, because Castle Lake's actually been very quiet in aircraft, right? They kind of got away from it into other things. So we'll see what happens there. And but I'll be at the air show. Hope to see you, Sarah. Hope to see other people that are on this webinar. Jamie and I will be there. Betsy?
I plan on being there too.
Well, I guess we'll have to wait and see what happens then. I do suspect there will be some exciting announcement both on the airline and the lessor side, but we'll stay tuned. All right, with that, I think we are at the end of our session. I want to thank you both for your time and the very insightful conversation. I've definitely learned a thing or two. Any other final comments before we we close this conversation.
Betsy, anything you want to say to people?
Nope, I think we've covered everything.
I'm good. I'll just say for those that aren't plugged in with our research and so forth, if you're a customer at JP Morgan and you want to get plugged in, just let me know. We're happy to do so. And like I said, hope to see many of you at upcoming ISTAT events. Please support the ISTAT Foundation. And with that, Sarah, I think we can close.
Thank you so much. Thank you, everyone, for joining. Mark, Betsy, thank you. And see you all soon.
All right. Thank you.